Hi folks, you're with us today, Tacitus Today, your pushback channel, and thank you for joining this audio live stream. In this essay, I'd like to talk about asset bubbles and or credit bubbles, call it what you like. And are we in a sort of a huge credit bubble now? And if so, how big? What might be the fallout from that? Is it going to all sort of burst, leaving dead bodies in all directions, or can it be managed down smoothly and carefully? So let's sort of have a look at. There's quite a lot in this. There's a vast amount to unpack, so I can only do a part of it. But let's look at some of the key issues. Is there an asset bubble? Well, certainly is. There's absolutely no disputing that. Is there a credit bubble? Yes, and because the asset bubble has been financed by loose credit, so yes, in both cases there. How bad is the asset bubble? How huge is it? How far has it got from reality? Well, there's a couple of things in that. Now we need to look at what's intrinsic value. Now, intrinsic value is that, and I'll use a very simplistic sort of analysis here or examples here. A loaf of bread has intrinsic value because people need to eat, people get hungry, and depending on the scarcity of a resource, whether it be bread or any form of food, there will be another factor of value there that will be temporary and artificial based on that period of shortage. As soon as the shortage is corrected, then the overpricing then comes back to the median. Now, say in the case of real estate, private homes, real estate prices can't really go much beyond the capacity of people to pay. So if wages are stagnant, then in a market operating system, we have to remember that whether we look at market or non-market or monopoly or something like that, but in a market-driven economy, people just can't pay once the prices of the houses reach a certain point. So then only larger institutional investors can come in and keep on purchasing. So it's now typically in housing, private residential housing, typically it's people buying it. So the price of houses never really got much beyond the price of, or the capacity of people to pay. So wages. So if wages are stagnating or, for example, going down, then people couldn't afford to buy the houses. So then there'd be, people would have, if people wanted to sell the house, they'd have to drop the price in order to find buyers and so on. And they certainly couldn't increase the price beyond a certain level. So the asset bubble type phenomenon didn't really occur in a market situation. Where the market's driven, you don't get that. So unless you get outliers coming outside of those market parameters. Now, typically price bubbles and price asset bubbles and thus credit bubbles come from where one group in society, whether it be big finance or whoever, big pharma, could be any, has the power to create artificial monopolies or oligopolies or cartels or to take control of public resources, taxpayer money, to such an extent that it creates this artificial market, which allows then artificial pricing, which, given the profit motive, will then go beyond any real market forces. For example, say COVID vaccines, and say they were available at an affordable price to the public, and then the public were allowed to make their own decisions on buying it, then there wouldn't have been many sales of the COVID vaccine. It had a lot going against it. It was a trial vaccine that was brought out quite hurriedly. Even the earlier sort of science suggested it didn't really work or didn't work as well as stated. So in a real world situation, not many people would have bought the COVID vaccine because the government intervened in league with Big Pharma and the globalists. That totally changed the outcome, so that the government was borrowing vast sums of money to give to Big Pharma to get the vaccine. So that created this artificial. So this debt that the government's gone into is part of this wider asset bubble, which means it's departed from intrinsic value. Once we accept intrinsic value has been lost, and that whether it be private housing or anything else, share market prices, that the stock market is wildly beyond any intrinsic value measurement. So, and no matter how much they try and put lipstick on it, it is far beyond. And I'll come back to that in a minute, and how what the indicators are that occurred. But if we accept that intrinsic value has been lost, and the borrowed money, thus the credit bubble and the asset bubble coming together, borrowed money effectively is being used to prop up this artificial value that goes beyond intrinsic value, then we say, okay, we can reasonably ask the question, well, how do we bring this back to the median? How do we bring it back to normal market forces? Well, that assumes that the globalists want to return to market forces. I don't think they do. I think they want to have this sort of centrally allocated monopolies that they give out to the globalist goons, so that each company, each business, whether it be big pharma or anything else, will have monopoly or oligopoly, or there'll be cartel pricing, and every segment of the economy will be carved up and divvied up amongst these globalist goons, in effect, and we'll all be forced to buy only from them for each thing we need, or pay them rent or whatever. In return, they'll pay us the universal basic income, and they'll collect a small profit from each human, or each individual. They'll collect a small profit from, because that'd be a monopoly. You've got nowhere else to go. And then again, they'll pay the universal basic income. But in order to make that work, given the small profit they can extract from each person, they need large population mass to do it. Hence the moving the large populations into the West, because the West is where they can best control this. So they'll pump more and more people into the West, then they'll have this universal basic income or some approximation of that. So I don't think they want I don't think market forces are even relevant in their figuring anymore. It's all a case of how quickly they can fully implement that globalist project, which is why they want to do it quickly, which is why they're terrified of Trump and anyone that opposes them or questions them, or even any social media person that questions them. They're terrified of this. They need total control of the narrative in order to implement their globalist project. So this credit bubble, or the idea of the credit and asset bubble, I'm not sure it's relevant in the same way that it once was, where that if we allow proper market forces to intervene, the value, the intrinsic value, price signals, market feedback, these sort of things, I don't think that we're ever going to go back to that, or the globalists at least want to oppose it. And we can see that in their energy policy, forcing us to pay outrageous sums for energy that just a few years ago was less than a quarter of that price. And we're saving you from Armageddon climate change. We're doing it to protect you, to protect little children, little girls dressed in pink are being protected. I mean, so that they'll do the scare campaign stuff. So I don't think they're ever going to return to what we would call market forces or market signals. It's going to be a monopoly controlled, in effect, a socialist centrally planned system of just multiple monopolies in the multiple categories and segments of the economy. Coming back to now how long it'll take them to implement that or put it in place, that's another matter. Whether they even get to do it is similarly a question at the moment. On balance, it looks like they're going to get it done. I would say that the power and control they have, their willingness or their not willingness, their universal determination to believe the citizen and their wants and their needs and requirements is utterly irrelevant. And we might be making all you people poorer and making you eat shit in the street, but just think about it. We're making sure black, lesbian, transgender people have equality. Yeah, are you against that, you fucking Nazi? So that they've got that all sort of signed up as well. Coming back to the idea of intrinsic value, and credit, the relationship between credit. When I first got bought my first property, which was a block of land, I had to put 35% down I think it was 35%, might have been 40, but I'm pretty sure it's 35% down. Now, if you wanted to buy a house, you had to put 25% down, possibly 20, depending on where it was. And the house had to be in good order. If you had to do renos on it, then you had to put a higher deposit on there, and like the bank would go out and inspect it, that sort of thing. So there's a lot of the prudential standards were quite considerable and quite high. So the idea of being able to buy something without a decent deposit, whether it be land or a house. So the first block of land I bought, I don't know, it was like $40,000 or something. I don't think it was even that much. But I had to put somewhere between $12,000 and $15,000 on the table to buy it. Then I had a house built on it. Then I had to put another chunk of money on that. Then I had to borrow thereafter. So I'd been very diligent and careful in saving my pennies to do that, which is what most people had to do in those days. And it wasn't unusual for people to work 3 jobs and all sorts of things, live a very Spartan lifestyle while they saved up their deposit, which typically they did when they were relatively young. This is before university education was considered the norm. A lot of people then were starting work at 16, or if not 16, 18. Or you get mugs like me doing college and working a full-time job. But the idea of credit or credit outstripping intrinsic value was, it kind of didn't really happen. I suppose you couldn't say never happened. I mean, there were always situations, the stock market runs on the stock market, that type of stuff. And you saw that, in fact, with the Wall Street crash in the 1920s or late 1920s. But this idea of outstripping intrinsic value, it could occur, but it was quite difficult. It wasn't nowhere near as easy then as it is now. And there still were recessions then when interest rates, if the economy looked like it was starting to overheat, governments would jack up interest rates and restrict credit. So these would create recessions, that sort of thing. And no one ever no government ever got it exactly right, the relationship between how much you allow credit to run freely and interest rates in the economy. So there were all these sort of booms and contractions and things like that. They still occurred, but not in the same way. Now, the same way as they would now, not in the context, at least, of this credit bubble. Also, with basic things like a credit card, the first credit card I got, you had to pay back 20% of whatever was on your credit card each month. And if you didn't make the payment, on time and in full, you'd find that your credit card got a pretty severe, you'd get a terse letter from the bankers. You missed by one day, or you pay by check, but the check doesn't clear until the following day. So they deem that as you didn't pay. Hey, motherfucker, you didn't pay on time. So you had to be really careful. I remember getting my first credit account at like a department store. You had to pay back 50% of what you bought in the month. And I think they had me on restriction of like $100 or something. It sounds quaint, if not ridiculous and absurd today, but that's how it was. So you couldn't get yourself into too much debt. It was quite difficult to get into uncontrollable debt. Now, there are different things. Now, say in houses today, the relativity of mortgage. The first house I bought, it was $70,000, and I was putting overall about $40,000 actually on the table. So the mortgage was actually quite small. I thought it was big at the time, but it wasn't. It was less than half the value of the house. This is different today. Being able to put sort of just a few percent or nothing down in some cases, but just a few percent on the table and then buy the house, but go into huge debt. So the ratio of mortgage to house is hugely different. A lot of people I know that have got maybe 10% equity in the house, and even that came from just increasing house prices, not from money they've put into it. So any sort of slowdown in price inflation means they'll be lucky to get out of the thing for, they're going to sell the place and still owe money, that sort of stuff. But also, how do you manage overpricing? If the houses are overpriced, the price of homes in Australia has increased at three fucking times the rate of wages. So clearly wage buyers are not buying these houses. They can't. And I've been to the auctions myself and noticed that the wage earner people, the locals, the wage earner people, they're dropping out in the first couple of bids. And then it's the institutional investors or the offshore investors using local nominees that are the only buyers. And the reality is that if the just before the mass migration began, there were places that you could buy for $250,000 that today are more than $2 million, $2.5+ million. And I remember just as the beginning, the first sign of these institutional investors coming in, that a place at auction that was listed for $250. And typically at the time, if the place was listed, the price that they listed, it was approximately, it might be $260 that sold for, or $245, but it was approximately the price it would sell for. But instead, they're looking at, the thing could sell for $600 because you've got an offshore investor just trying to launder money, whether it be from China or India or anywhere, one of the big banks or anything. It doesn't matter. But they were buying up these institutional investors were buying up the property, and the wage earner didn't have a chance. So really, the prices were far outstripping what the wage earner would have paid. So that was the beginning of that asset bubble in real estate, that it wasn't the wage earner. If the wage earners had been buying the houses, then it would have sold for $250 or thereabouts, because the wage earners were turning up already having done their sums, saying, yeah, we can afford a mortgage, assuming the house sells for $250. As soon as the bidding gets to $280 or $290, they're out of the game. The wage earner don't have a chance. So that was where the asset bubble was beginning around that time, and it was allowed to run. But it wasn't as a result of the purchasing power of the wage earner, which should have been what drove the price of homes. So this is what's changed, and this is the asset bubble. So the price of real estate, private residential real estate, represents the money laundering desire and the money, the mass of wealth of the big institutional investors to go and buy private real estate. Again, with this idea of you'll own nothing and be happy, that they will own everything, and then everyone will be a renter renting from them. And there have been entire areas, suburbs even in Australia, in Sydney, that have been bought up by these institutional investors. And they're not a reflection anyway. Now, I noticed this when I first looked at I'm a bit of a statistician, so I did the hard numbers on spreadsheets with real estate in a certain regional city in Australia where they'd lost a lot of industry, so the average wage declined quite a bit, and the amount of people that were making even double the average wage was down to 3%, so a tiny proportion. And in terms of people in the upper echelon, you were looking at a handful of people. 50 people were making the big bucks in that city. So I noticed that the real estate was taking longer to sell. So say the average time a house was up for sale was 11 weeks. That changed to 40 weeks, nearly 4 times. So purchasing power is declining. The average time to sell a house is increasing to 40 weeks. Yet the house price is more than doubled over that few-year period. And that's an impossibility. You can't do that. There just aren't the people there with the money to do the buying. But it was all institutional investors were coming in, buying up the real estate. So the real estate wasn't dropping back to market stimulated pricing. It was purely a reflection of the institutional investors. Now, the same goes for the stock market, where if you look at the average sort of trade buying, the buying of shares that occurs in a particular stock, particularly the ones that have gone into the stratosphere, then say they for example they turn over million shares a day traded on that particular share on the stock market. Then the average volume of trades dropped from 1 million to 500,000. Then it dropped to 300,000, and yet, even though the trade volume was dropping, so clearly people weren't buying. Even though trade volume was dropping, the price of the shares was galloping ahead, going into the stratosphere, and even while trade volume was dropping through the floor, and then the gap between intrinsic value, that is the value of the company, the business, and the share price, it was so far out of proportion that it was insane. Now, the claim is, or certainly in some cases, that all that share buying that was pushing the price up, even though there were declining volume in buyers, that is, there were fewer buyers, the people that were buying were using borrowed money to do it, to overinflate the prices. So we've got in private real estate and in the share market, we've got this far outstripping intrinsic value, and by leaps and bounds, around the same ratio actually, which again suggests it's very centrally planned and controlled. So these shares have to come, or the prices in a market situation would have to come back to intrinsic value. But I don't think that's what's going on here. I don't think intrinsic value is as relevant as it was in the return to market forces, because typically what would happen is a bunch of well-connected goons would corner a particular section of the market or whatever, and everything would be out of control. Prices would far outstrip intrinsic value. Times were good. Who cares? And then it would come back to a market price. And this is something I think that the globalists won't allow. And again, for the reason I mentioned earlier about monopolies and so on. So I think the credit bubble and the asset bubble, we're in different territory now of globalist carved up international financial sectors and economic sectors. And I think that is now the wild card and the difference when we look at change to asset prices. Are asset prices wildly overpriced? Sure, but they're owned by a small cabal of globalists who can really make the rules as they go along. And then I think that's what they'll do in this instance. You've been with Tacitus today, your Pushback channel, and thank you for listening.